Hello everyone. Some shocking numbers around consumer credit have been released by Federal Reserve. So let's go through this article quickly. Uh, the November customer consumer credit report from Federal Reserve was an absolute stunner and confirmed that we have been saying for months. Any excess savings accumulated by US middle class are long gone, and in their place, Americans have unleashed a credit card fueled spending spree. So basically, no more savings left, and consumers are relying on credit for more purchases. Here are the shocking numbers. In November, consumer credit exploded to a whopping $40 billion, double the expected 20 billion, more than double the 16 billion October number, and highest on record. So this chart goes all the way to 1943, and as you can see, 40 billion is the highest ever, which is insane. um, and the if you can see, the October was somewhere around here, 16 billion. And while non-revolving credit, student car and loans jumped by a solid, if not necessarily remarkable, 20 billion. This was only the seventh biggest increase for the series on record. The real stunner was revolving or credit card debt, which was more than tripled in November. So credit card debt tripled in November, soaring 19.8 billion from 6.6 billion in October, by far the highest such print on record. So revolving credit was also highest ever, and this series go all the way back to 2001. While this unprecedented rush to buy everything on credit ahead of and during the Thanksgiving holiday should not come as much of a surprise, after all, we have repeatedly shown that for the middle class, any excess savings are now gone, long gone. So as you can see from the chart, savings rates are now back below the trend line. So with that in the backdrop, when basically the public have spent all their stimmy checks and is back to relying on credit for Thanksgiving purchases, economy is about to be hit with triple whammy. Uh, Quantitative tightening, pandemic, and inflation. So let's start with the pandemic. As you can see in this chart, and this chart I shared about 2 days back. I made a video on it as well. Please find it and go through that. I discussed everything in detail about this chart. And this is nothing but, office space usage in all major US cities. And similar behavior is happening across the world wherever new variant is wreaking havoc as well. And what this chart is indicating is the office space usage is just like when the pandemic started, is falling off the cliff again as this new variant is causing problems. By the way, I was in Melbourne CBD yesterday, and it was quiet. In fact, I should say it was dead. Yesterday was Friday, the 7th, and I would say about 80% of the shops were closed. So it's not just a US phenomena. Anywhere this variant is there, and lot of public um, is affected by it. Um, this phenomena is actually visible, and this is very deflationary. Why? Because if people are not going to the city, all these businesses, small and medium enterprise businesses, they are not running anything. Like I said, 80% of those shops were closed. And city is just one example. I mean, bottom line is, if because of the scary and people are staying at home, they're not going wherever they need to go to work, especially if their job cannot be done remotely. So all those businesses are not earning revenues, which means if they will have to let go their staff, which means that staff will no longer have income either, which means businesses as well as the staff, they uh, um, uh, will not spend, which means if they're not spending, less demand, which means recession. Now, granted, pandemic scenario has also hints of inflation in there as well. And the reason is, when people stay at home, they are not producing either. And if they are not producing, that means it is impacting supply side of things as well. So no production of things means less availability and higher prices. But the fact of the matter is, a pandemic should really scare the bejesus out of everyone, which is exactly what is happening when people stay at home, which is highly deflationary. And the proof of the pudding is, um, while sorry, when the pandemic started in March 2020, everything basically tanked because everybody was scared. So in other words, yes, there are supply side issues, but that those are nothing compared to the demand side of issues. So that's pandemic. Now let's move on to next one, which is inflation. So next chart here is from Federal Reserve Bank of Cleveland. And as you can see, CPI is 6.8%, which is almost 40 years high. I mean, last time inflation was this high was in like 1970s. And just like sickness, high inflation is also very bad for the economy. Why? Because purchasing power of public decreases, and if the purchasing power decreases, so does the consumption. And US GDP is anywhere between 70 to 75% consumption. So all the revenues around discretionary items pretty much gone, because public will try to uh, save as much as possible for necessities, and necessities will be the only things consumed. So yes, granted, revenues of the companies, which are into necessities, or things that are consumed daily, um, will be in good situation, but everything else will be bad. In fact, inflation is not only it may not even be good for the those companies either. Why? Because if there is wage inflation, then their profit margins may actually decrease. So in other words, basically less profits going forward, which means less growth. And if there is no stimulus, which is the natural direction for an economy, the economy will be going into recession. Next, let's move on to the next one, which is quantitative tightening, and we can add, rate hikes also to it as well. Now, quantitative tightening at first will only reduce additional liquidity from the economy. So there will still be net additions to the economy until March. And after that, any rate increases will be net liquidity reduction from the economy. Again, very deflationary, because liquidity reduction will mean that all asset prices will have to go on the lower side, be it stock market, gold, house prices, cryptos, you name it. And again, barring any stimulus, economy will be in recession. So bottom line is all three are very recessionary, and all three are rearing their ugly head. And when public is left with no or very little savings, as we discussed in our article here, these three, pandemic, QT, and inflation, will push economy into recession for sure. And only way out will be to print more money, which is the usual. However, the only question at that time will be if politicians will be okay with this, with saving the stock market and also let inflation run high, or they will allow stock market to crash at expense of low inflation to keep the sheeple happy. Now I don't have answer to that, and time will tell, but I think politicians will choose path of least resistance, which would be something on the lines that somehow tame the inflation before midterm elections so they can get elected, and that could be at the cost of stock markets and rest of the economy. But after that, as soon as they get elected, money printers goes burr, and and as if as if inflation or hyperinflation is not at all an issue for them. So yeah, those are my thoughts. Please share yours. Please subscribe, share, like, and comment, and I will see you in the next one. Bye.